suppose you are a new trader and you don't know how to make levels, and you don't know how to do the trading and which levels is referring as a resistance or as a support. Let's say you don't have any knowledge about this type of technical simple resistance and support, but you still want to do trade. So this will be helpful for you as well. And suppose you are into algo trading, like you know the programming about taking the trade from the chart and some technical indicator that you will use to do the algo trading, then this can be one of the strategy that you can also include. So this is for both the people who knows pretty much about the program algo trading, and the new traders who don't know anything about it. So they can just use this type of simple strategy, and they have to follow the strict rule for this, and then they can do the trading about it. So let's start. So these are the moving averages. So what type of moving averages we will need in this intraday trading setup for doing the trading in any equity or index or even in the commodity. So these are the main 4 indicators that we are going to use in this strategy. First one is a 10 EMA. EMA means exponential moving average. Then 20 EMA means 20 exponential moving average. Then 100 exponential moving average. Then 200 only moving average, like a simple moving average. It will be not there as an exponential moving average. So total 4 indicators that we are going to use: 10 exponential moving average, 20 exponential moving average, 100 exponential moving average, and 200 moving average. So what are the general conditions to apply for this type of strategy? So first, our time frame, this is only for the intraday. So first, our time frame should be 3 or 5 minute chart, but I would like to prefer for 5-minute chart. And then if you want to see like if it is a bullish trend or it is a bearish trend, so you will get this condition, like if 100 exponential moving average is greater than 20 exponential moving average and 20 exponential moving average is greater than 100 exponential moving average, then bullish short-term trend means that in that intraday you will get the bullish trend, but it will be not like for a long term. And then if this second condition, like all these small moving averages, 10 exponential is greater than 20 and 20 is greater than 100 and 100 is greater than 200, so this shows a very good bullish trend. So this is, if here we are not considering 200 moving average. Maybe in this case, the 200 moving average are all above these 3 averages. So that's why we are considering as a bullish short-term trend. But here 200 moving average is below all these averages, exponential averages. So that's why it is having the good bullish trend. Now it is a vice versa, totally opposite to this condition. It will come under the bearish trend. Like 10 exponential is lower than 20, 20 is lower than 100. So it will be bullish short-term trend. Maybe here the 200 moving average will be even below 10 EMA. So it will be even below this 10 EMA. So that's why we are considering as a bullish short-term trend, because 200 moving average is a kind of average which is like very strong moving average. It will immediately go to take the support and bounce pretty much from that, or it can break down and it will go down like give them sudden fall from the 200 moving average. So 200 moving average is like a very good support and very good resistance for our this strategy. So now another condition is like if all these 3 moving averages, exponential moving averages, are very close to each other, then at that time we will avoid to enter in any type of trading. We will just wait and watch that once it will have the proper, because if they are together, there will be chance that this condition at one point looks proper, but in the next candle it will change, because these are the exponential moving averages, so they are changing quite with the pricing. So these are the general condition. So I will just take you to the chart. Like let me draw. Like this is 10 exponential moving average. We will mark it with the green. Then this is 20. We will mark it with orange. Then this is 100. We will mark it with. So we can see 10 exponential moving average is greater than 20, and 20 is also greater than 100. So this situation, this condition has been satisfied. And in that, let's say our 200 moving average is somewhere here. We will mark it with purple, and we'll mark it a bit big so that one. So this is 200 moving average. This is 10 EMA. This is 20 EMA, and this is 100 EMA. So we will fix this color so that we don't have to write again and again or explain again. So green is our 10 EMA. So orange is our 20 EMA, and 100 black line is our 100 EMA, and this thick purple line is our 200 EMA. So this is the first condition. 10 EMA is above 20 EMA, 20 EMA is above 100 EMA, but we are not considering where is 200 moving average. So the 200 moving average in this case will be above all the three averages. So in this condition, it will be having the short-term bullish trend, because this trend line will work as a major resistance. 200 is kind of that type of moving average, which will act as a good resistance, as well as it will act as a good support. Now let's say this was the first condition. Hope this is easy to understand for everyone. 10, 20, and 100. And then the third condition is like this. So our 200 moving average is 200 moving average is below all the three. So 10, 20, 100, and 200. 10, 20, 100, and 200. So this is our 10, 20, 100, and 200. So this shows the good bullish trend in the system, in the equity, or whichever the stocks you are trading. And now this, for the bearish trend, it will be the difference. So it will just do this opposite. So first condition, 10 EMA should be below 20 EMA, 20 EMA should be below 100 EMA. So this is 10 EMA should be below 20 EMA, 20 EMA should be below 100 EMA. So this shows the short-term bearish trend, because in this system we will have that 200 moving average will be below all these three. So as I already explained, like it will work as a good support. So that's why we are considering as a short-term bullish trend, because if 200 moving average is there, and then it has a chances to even break down and bounces back from the 200 moving average. So that's why we are considering it as a short-term bearish trend. And now in this fourth condition, which is 10, 20, 100, all are below 200 EMA. Sorry, 200 moving average. So 10 EMA, 20, 100, and 200 moving average. So this is the type of scenario that you will see on the chart. Hope so far till here is clear for everyone. So first, let's apply these moving averages on the Nifty Bank. So this is the chart of Nifty Bank. So we will go to indicator. We will write this is simple moving average, and this is moving average exponential. So we need three moving average exponential, 1, 2, and 3, and we need one moving average for 200. So here you can see 1, 2, 3 exponential moving average, and one is moving average. So first, go to the setting here. We will go to input. We will put the length as a 10, and then we will change the color for green, and we will set OK. Then second, we will go to the settings. We will do the 20, change the color of 20 to orange, say OK. Then we will go to another EMA. We will write 100. We will put black color on it and say OK. And then this is MF, moving average, so simple moving average, so 200, and we will put the purple color and make a bit thick. Okay. Sure, I will share the PDF with you all the guys. Green, we already know 10 exponential moving average, 20 exponential moving average, 100 exponential moving average, and 200 moving average. So first rule for the buy, like in general, whenever these are the short-term moving average, like 10 and 20 are very short-term moving average. Whenever the price goes far from it, it has a tendency to come back towards this range. So I will take the example of this. So our first rule says, whenever this type of like 5, 10, 15 are the small type short-term moving average. So whenever the price goes away either from the top or the bottom, it will have the tendency to come back near this moving average, or otherwise this moving average has to go near to this pricing. So first condition is once it goes away, and if it is coming back near to that 10 moving average, and in that period, like when previously it was going away, it will make a swing. And once that swing has been taken out, the high of that swing has been taken out, then in that condition, we can enter into the buy trade. So let me just draw an example. So let's say this is 10 moving average. So your price is going up. Let's keep on going up. And after this, it will come back to moving average. So when it is continuously going up, we are not taking any trade. And in this, like it is going up here then, and then it's going started up, and then it is coming back. So in this, it has made this swing high. It gave this swing and it made this swing high. So in this rule, once this swing high has been taken out, then we can enter into the buy trade. So this is our first condition. But in that, we also have to check that 10 EMA, 20 EMA, and 100 EMA should be, this condition has to be met. Otherwise not. We will not take the trade if your 10 EMA is here, your 20 EMA is here, but 200 or 100 EMA is here. So this is not a satisfied condition. So we will not take the trade on this swing high breakout. We will only take if 10, 20, 100 exponential average that buy trade condition, this condition has been satisfied, and then we will take the buy trade once this swing high from this exponential moving average has been taken out. So what could be the SL? So SL of that candle which break the previous swing high, and trailing SL will be 20 exponential moving average. So once you enter, in this candle, so this candle has been, this candle, let's say, break out this swing high, and the low of this candle is here. So this could be your SL, your entry will be here, and your target, so your target risk reward is for 1:1.7 first, then second target will be 2.15, and then 2.8, then 3 and 4, on and on. So if you enter in the long position, let's say you are entering from here, so your SL will be here, your first target 1:1.7 will be here, then you can mark another 1:215, 1:215, almost here, so it's just a small target, then 2.8, this one, then 3 and 4, on and on. So we will just consider in between somewhere here. So this will be your target, and this will be your stop loss. So this is considering the condition where 10 EMA is greater than 20, 20 EMA is greater than 100, and all these three averages are above 200 moving average as well. Hope so far it is clear. Please write in the chat box if you have any question. And let me take you one example of it, if I can show you from the chart. So far it is clear, this first condition for the buy trade. Everyone, please. Okay. So let me just show you one example where it was satisfied. Okay, here it is. So let's say here these moving averages are pretty much close, so we are not taking any trade. But now they have separated, so we can see. Yeah, see, these are all the trades are near, all the moving averages are near. So even why we are not taking the trade in such condition, there are probability that it will hit your SL, because these are towards these exponential moving averages are close enough here, like a kind of they are converging together. Let me take one more example with the proper idea so that you can easily get it. 200 MA वो काफी स्ट्रॉन्ग है, और उसके बाद आएगा 100 एक्सपोनेंशियल मूविंग एवरेज, तो वो काफी स्ट्रॉन्ग इमीडिएट सपोर्ट रेजिस्टेंस जो देगा वो है 100 एक्सपोनेंशियल 100 EMA, एंड देन यू कैन सेट 200 MA. सो अभी यहाँ पे हम देखते हैं कंडीशन हमारी यहाँ पे सेटिस्फाई हो रही है, तो देखेंगे कि यहाँ पे अभी प्राइस जो मूविंग एवरेजेस है वो दोनों ऊपर है और अभी दूर जा रही है, it's going away from being together, so that's why we were not trading here. So let's say this moving average is going up here, so here it is making a swing high, but it is keep on going away. Let's say we are not able to catch this trend, so we are waiting, keep on waiting and waiting, we are not taking any trade. So once you get the experience and get the more experience about using this trading, you will even take the trade on this candle. Why? Because 100 exponential moving average is below all these two, and 200 is also below this 100 exponential moving average. So this is shows good bullish trend, and you can see the bullish trend is very good. It was pretty much good, this bullish trend. So let's say you are not able to trade, take the entry on any of this candle because you don't know where to take the entry. So price is going up, but if you see here, price is going up, coming down to this, and again going up. So we can say this is the swing high that it made. We will mark this is a swing high it made, and this candle broke this swing high with the closing, not the wick. We need the closing above this swing high. So this candle broke the swing high, like it goes up, take down, and again give the swing, and this swing high has been taken out with this candle. So let's say we are going with the trade on the next candle. So we are entering at the quick entry and keeping the stop loss here. So first target is 1:1.7. So this candle immediately achieved. The next target was 2.15. This candle immediately achieved, and we can see the 1:3 is also achieved, and this is 1:, 1:3.78, and your trailing stop loss will be this 20 exponential moving average. So you can trail your stop loss with this 20 moving exponential average. So there are two types of trade to take the stop loss from the 20 exponential moving average. First one, as soon as it hit the 20 exponential moving average, you will exit. And the second one is as soon as it closed below 20 moving average, you will exit. So I will explain both the scenario, which you can use at what time, since this gives the bullish trend. So in this situation, if the 20 moving, it gives the closing below 20 moving exponential average, then and then you will exit. Otherwise, it will touch and it will go bounce back, because a 10 EMA is above 20, 20 is above 100, and 100 is about 200. So it shows the good bullish trend. So whenever it is touching 20, we will not exit. Once it closes below 20, then we will exit in this type of trading. So you can say so far it was touching the 20 and moving back above, and even it was giving the good bullish move, and then it closed below. Here you can consider close below, or here you can say close below. So this was your trailing stop loss if you are a positional trader. So here was the stop loss of your trailing target. But we are talking about intraday only. We are not talking about positional. So this is the scenario, like you are able to achieve this one because you are trailing, and throughout the day your trailing stop loss was never hit. So this was the perfect trade for this.